Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. Hey everybody, and welcome back. Today is an episode you're not going to want to miss if you're sick and tired of pissing marketing money away and seeing no results. I know you're going to love this one because I've got Shiv Narayanan on the show, and he is the founder of How to SaaS, and he's had quite the journey. He's scaled and sold his own company, Wild Apricot, to private equity, and since then he's been working with PE firms and founders to grow their businesses by aligning all of their marketing initiatives and spend to their long-term goals of cash flow and equity growth. And what I love about Shiv is that because he's working with PE firms, the results have to be there. It can't just be made up and hoping that we're going to grow and hoping we're going to have the right kind of growth. It's tied to the right kind of growth of cash flow and equity growth. And then he talks a lot about how to take your marketing strategies and your company strategies, productize your offering in a way that makes sense to your clients and that can lead through a customer journey, measuring client acquisition cost, the lifetime value of a customer, tying that all into cash flow and equity growth. Shiv has also written 2 books, Post-Acquisition Marketing and Exit-Ready Marketing, that just prove that he's been there, done that in the marketing space, as well as a business owner. We talk a lot about owner versus operator, how to align those two with the goals of the owner of the company. And I know you're going to love this. If you want to know more about Shiv, check out the show notes below. Otherwise, share this episode with a friend, and please leave a review on the podcast player if you're enjoying the show. Thanks everybody for tuning in, and I really hope you enjoy this episode. I'm very excited. Much thanks to Marcel, who introduced us. And I think it was through another friend that Marcel knew. But anyways, I was very pumped to hear your angle, your expertise as far as like sales and marketing through the lens of private equity. And specifically, they have one goal, which is IRR. And so like you've positioned yourself as that. And I think, you know, Shiv, one of the biggest things is that you and I were just talking before we hit the record button is like, I just got done with one of my ownership accelerator calls, and like people that are owner operators trying to get into that ownership spot where they're decoupling their labor from their jobs. So they're going to have to extract the KPIs that are tied to the financials. And I think a lot of these systems, Shiv, just miss that part where it's like, oh, great, we got goals and KPIs, but it's like, if it doesn't generate more cash flow through distributions and equity growth, like just don't do it. And that level of clarity is so obvious to private equity firms, and why I get fascinated with people that have found a way to work with PE firms is because like you either delivered or didn't. You know what I mean? There's not a lot of gray area. So why don't you just give us, with that kind of context, I'm very excited to have you on here because you have figured out how to do all that in the marketing space. So why don't you just give us a little bit of your background?
Yeah, so I used to be the CMO of a software company called Wild Apricot, and we sold that to private equity back in 2017. And then the PE firm that bought us flipped us to a different private equity firm in 2018. And both of those private equity firms started pulling me into their other investments because the business that we had built, Wild Apricot, we'd grown to about 20 million in AR without a sales team, so all through marketing. And that was quite unique in the market.
What did Wild Apricot do?
We did membership management software for small clubs and nonprofits. And so in the PE world, most companies are sales-led and built with the SDR AE model, and marketing as the main value creator or enterprise value driver is quite rare. So they started pulling me into their other investments to help coach them on how to scale up their respective marketing efforts. And I saw that as an opportunity to start this firm now. And what we do at How to SaaS is we partner primarily with private equity investors that are buying and selling companies. And as they are making those investments, we come in during a due diligence phase and do initial analysis. Post-close, we help them optimize and build the value creation plans for those companies. And then we also provide fractional CMO services to those companies. So it's all on the marketing side, strategy consulting. And the best way to kind of think about it is like a McKinsey for marketing.
Dude, that's so awesome. And I'm just, what I love is you have to deliver the outcome. Right. So you're proven. And I think and I've had so many people on the show, Shiv, over the years where like someone might seem like they're a great expert, but like if they don't deliver all the way through the life cycle of generating more cash flow and equity growth, it's just kind of just thought process. It's just talk until they can actually thread that needle all the way through from client acquisition to client retention.
So I think one of the things that I've had to educate the market on and break the mold on a little bit is when I first started in this business, there's a ton of clients that I had to say no to because they were looking for an agency. They would come to us and say, or initially it was just me. So they come to me and say, "Hey, I need more leads. Can you do Google Ads for us, or can you help me with SEO?" And my answer was always no, because one, I don't want to be an agency. Two, there are tons of agencies out there that do that kind of commoditized work. And three, I really wanted to sell the C-level advisory level marketing expertise that I could charge a premium for, and that was in my wheelhouse and specialization that really wasn't out there in the marketplace. And so the expectation setting piece is super important, because everybody wants more leads, more pipeline, more revenue, and more EBITDA yesterday. But if you think of it as a process and in terms of value delivery for a client, you have to first understand what is the starting point for a client, and what does a meaningful transformation look like. And so if you've never done any marketing and your marketing contribution to pipeline is, let's say, less than 10%, if we can take that from, let's say, 7% marketing pipeline generated to 15 or 20%, that is an enormous transformation, and it is worth a ton of money. So really understanding what your client's starting point is, and then framing the value around that, and saying, look, because you were not generating enough pipeline, there are some foundational steps you need to work through, and then you will start to see returns. And framing the problem like that really changed the game for us. And it took me a little while to figure that out. And now, like in my second book and everything, like, I've explained that, like, how do you figure out what your starting point is, and where are the gaps inside your organization, and what is the process you need to take your companies through, and how long should that take? It can't happen in overnight. It can't happen in 3 months. So some of these transformations can take 6 to 12 months, but investors need to understand that, and then they can set expectations and their revenue projections accordingly.
So much to unpack there. Love the context. And what's interesting, and to comment, and then a thought and question is the the return that you're talking about and the value creation. Like, what do you find it easier to sell? Like, once you understand the whole like multiple and the normalized EBITDA and the debt, like that whole valuation equation, Shiv, is it just easier to sell to private equity firms because it's like, hey, this is an add back. Like, you're gonna maybe do some like upfront costs. It's an add back use of cash, but it should grow your multiple, and you can prove and have that conversation. Or because I like the contrast to that is revenue K1, this is an expense, and everything I'm doing against you, or I'm doing with you, is an expense against my K1. I guess that's the shift of mindset I'm trying to help people with.
Yeah, yes and no. I'd say the private equity investors are some of the most sophisticated partners that you can work with. And so regardless of what you're selling, we sell strategy consulting on the marketing side, but even if you're selling pricing or sales or agency services, the question isn't if something is a good idea. And I'll give you some examples. There's so many cases where I come into a business, a PE firm will bring me in, our CEO will bring me in, and we'll look at what they're spending in an area, and they may have 2, 3 agencies helping them with Google Ads or PR and other stuff. And we will cut a lot of those agencies because it's the easiest spend area to cut, because the company should actually be focused on other things. So you're not competing with uh, ideas in a silo. Like, yes, Google Ads are a good idea. Yes, SEO is a good idea. Yes, PR is a good idea. You're actually competing with all the money you could spend in those areas versus what is the opportunity cost. And because private equity investors are so sophisticated, they understand that as a business, you're a business owner, you can't work on 10 things at once. A business in general can maybe work on 1 to maybe 3 things max, and be effective. And so the trade-off is, should we work on marketing or pricing? Should we work on pricing or sales efficiency? Should we work on sales efficiency or M&A? And each one requires a ton of resources and people and data and effort to make a reality. So what we actually have to explain to these firms is it's a lot about positioning and helping them understand which trigger events or situations we can come into. And that's what we put in a ton of work into this, to educate the market. Like, if you look at the 2 books back there, like that I've written, the first is called Post Acquisition Marketing, and the second is called Exit Ready Marketing. It's very situational. So I could have written 20 other marketing books. Like, there's a ton of ways to position marketing content, but I wrote the first book, Post Acquisition Marketing, because I noticed one of the most common situations that we're brought into is when a private equity investor makes an investment, and there's a confluence or a perfect storm of things that happens in that moment, because when you make an investment, you have a lot of capital that you can deploy into service providers and due diligence consultants and
Money and movement.
yeah, because money's moving and exchanging hands, so you need lawyers, you need accountants. And so I was like, there's nobody really doing marketing due diligence. That's the perfect time for us to provide that. So we're a category creator. There was no term on Google called marketing due diligence until we came along. And so it really doubling down on that and then writing the content around that and then educating the market. Now, whenever there's an acquisition with our PE investors where marketing is a significant lever, I get a call
They think of you.
inbound.
Okay.
And even though there are a ton of agencies out there, but nobody has kind of figured out why that's important or what the investor is really looking for in that moment in time. And as time has gone on, we've identified like 20 other scenarios where these investors would really think about us. And so that's how we kind of talk about our offerings. It's less so about, oh, we can do a particular tactic or service for you. It's how can we help you in a situation. Another example
Situation
is
which is tied to a problem where like someone has a problem that they need to
yes,
overcome to get to their goal.
exactly. So like another would be like you recently fired your VP of marketing and you currently as a CEO is playing the role of marketing leader. No CEO wants to do that. It's super frustrating. You need a partner that you can work with. So whenever a PE firm has a portfolio company where they fire a marketing leader, they have a partner now that they can call. So like if you set things up as per those situations and really understand your customers' pain points, then you can build solutions that address those pain points more than just like products that you're selling and trying to convince people to buy.
So I love it and I subscribe to it because it's the whole the whole story brand and like find the problem. And I like, and Bob Moesta was on my podcast years ago. Shiv, I don't know if you heard that, the jobs to be done where it's just, so like, amen, brother, totally subscribe to all that. I love it. And that I think would be interesting, even within light of your two books, those are the two mindsets when you think about the people listening in that are my clients, my listeners. It's the owner operator, and like what I call it the red pill experience, where they go through my workshop where they have this owner operator. There's a lot of operating systems out there. I need an ownership framework to drive my equity or my cash flow and equity goals. And then there's ownership duties. So I like that red pill experience. Shiv, I actually compare it to like, pretend you bought your company today. Right? Like that is the red pill. You see the zeros and ones. You are not just the operator. And so then there's this whole like, okay, well, you need to get your financials in order. You need to actually figure out where to spend your capital. Because I'll put a container around this because I'm kind of highlighting into then the post-acquisition playbook, like the due diligence. I think that you can really provide some value here because it's this mindset of like, okay, I now know that it's not just net income, it's normalized EBITDA. Normalized EBITDA, I got to pay some taxes, I got to take some distributions. So let's add $1 million and now got $500,000 left, Chip. So like that's now what I got. Where the hell do I spend that as an owner? And then you look at kind of your strategies, but I think sales and marketing, out of the three functions of the P&L and the three functions of EOS, it's sales and marketing, ops and finance. You're doing the due diligence on the sales and marketing side, is from what you've said. So what are you looking at? And you even mentioned that these PE firms were kind of dealing with this sales-led versus marketing-led. I think a lot of owner-operators deal with that same thing. But like, I think that I'm teeing this all up to say, I think your book and your philosophy is very much in line with the people listening going, okay, like, where do I focus on and how do I look at this?
Yeah, I think one way to start off just to level set is to say that a business that can be sold is worth not selling. It's worth continuing. So if you can't sell your business, there's something inherently wrong with your business or some level of maturity that still has to come. Because if we were, let's say the two of us were going to go try to acquire a business today, there are certain assurances that we would need because it's a very risky proposition. Like instead of deploying capital into a private company or buying a private company, we could just deploy it in the public markets and have way more safety and security and get a guaranteed return of some kind. But in private investments, like you don't have that certainty. So there are certain reasons why deals fall apart. Number one, I'd say, is revenue unpredictability. Your revenue is just super lumpy. Some months it's like you're in feast mode, and other months it's famine mode. Just cash flow is uncertain. And so that scares investors away. And a lot of founders just don't have this fundamental down right. And so they can never be acquired. And it's a good business for them to run and operate because it's kind of
But they're
profitable.
usually doing it on gut, right? It's like, okay, well, I know that we had these many like, but we can't, like, if you and I were the board members and we logged in and said, okay, if we're going to predict the income statement years into the future that roll into the cash flow statement, if we can't predict how the hell you're going to get those GL codes filled, like, what are we doing here?
And if you can't have that level of predictability, nobody's actually going to buy you. Because and the crazy thing about it is, and I talk about this in the first chapter of my book, is it starts with a story of a founder who almost gets his company sold, and then the deal falls apart, and then he's trying to unpack why. And the issue is that when you don't have predictability, the investor, even though they're super, they need to deploy capital. What founders don't understand is that the entire investor business model revolves around raising money from LPs.
Buying things.
Yeah, they need to raise money from LPs, and how they get paid is they get paid a small percentage as a management fee, but then the real money that they make is when they buy assets and they sell them for a premium, and then they get carry on that, and then that becomes like their lump sums that they get on an annual basis or whatever. So one of the hardest things for an investor, like if you poll all the private equity investors out there, you ask them, what's your number one issue? They'll say deal flow more than anything. It's very rare to find an investor that has a ton of deal flow. And the reason is that they all kind of look the same. They all have 500-600 million plus, maybe billion plus. Some have 10 billion plus in capital. They don't all have the big brand name. And so when it comes time to acquire companies and there's an asset out there, that asset has 20 different potential investors chasing after the same asset. There's a metric out there, it's called dry powder. It's the amount of capital that's sitting on the sidelines that's not deployed. Guess how much?
1.5 trillion, isn't it? No,
it's actually close to 3 trillion now.
Does that include like credit? I mean, I could get into like the different money supplies, but it's so funny because you know what I do in my workshops? I pull up the U.S. Census Bureau and I go through the different levels of privately held companies and where they're all at. And the Pareto principle is 95% of companies are below 5 million. So like everyone's the $3 trillion. You put some leverage on that, they could buy the entire freaking privately held market like 5 times over again, and they can't figure out where these people are.
That's the issue, is that they want to deploy that capital, but the reason it's uninvested capital is there aren't enough quality assets out there in the marketplace. So if you and I, let's say, somehow convince Mark Benioff to take Salesforce private, we would find a lineup of investors out the door that are actually interested in that asset because it's a premium asset, and where else are you going to deploy your capital? But if we were to take just a regular company that's doing 2 million in revenue off the street, it just doesn't have the fundamentals for that capital to be deployed. So first is recognizing that these investors actually want to deploy their capital. They're very interested in meeting you, in investing in you, because that's how they make money. So then the question is, well, why aren't they? And revenue and predictability is one of those things. 2 is the business that's way too reliant on the founder. And so you have like a key man risk to the business. 3 is maybe it's too reliant on a certain set of customers. And because of your clients and people that listen to you and follow you or agencies, I'm sure there's a chunk of them where more than 50% of their business comes from a handful of clients. That in itself is too risky. You lose one client, like 20% of the business is gone. It's not worth it to acquire that business because it's relying on one relationship. What if one person leaves at that target client? I've already lost my account. So if you just look at those 3 factors and you ask your companies, like, do you meet just those basic requirements? And they don't, then that becomes a roadmap to execute on to get to a level of maturity where your revenue is predictable, where it's not founder-led entirely, where functions of the business are being led by an executive team, where your revenue is not concentrated within a limited set of customers. And then there's like administrative reasons why things fall apart, where you have bad financial data, or just, you have tax issues or legal issues or other things. But I'll put those aside. But I just say looking at those 3 things gives us a pretty.
I think you named the 3 hardest, right? Because like I could go back and like there's so many value assessments. Like, I mean, I've taken a bunch of them. I've subscribed to a bunch of them, whether it's John Warlow's or something called the VOP and all these, like, and I think what you just did is you highlighted the 3 hardest. Cause like what I realized, Shiv, is years ago I had a consulting firm where we did a lot of those value assessments and people would be like, duh. And then it's like, Yeah, I know. Like, so there's the tactical things that you're talking about, administration or operationally, but like I think you highlighted the three hardest things. And I think it's interesting because when you look at an income statement, it all starts with revenue. And then ops has to service the client or give the product or service or the product or good at the margin. And then overhead has to be in the line. So like you're like everything starts with sales, man.
100%. Yeah. And out of the three that I mentioned, I will say that the most important one, and that's why I focused my book on that, is revenue and predictability, because because you know, let's look at a really big name like Gary Vaynerchuk. That VaynerMedia moves with his brand, but nobody would be afraid to invest in VaynerMedia because of the size of the business and the predictability of the revenue and how many customers they have and lack of customer concentration risk. So the bigger a business gets and the less reliable it becomes on the founder, like that's all valuable, but you could still have a key man risk. But if the business has sound fundamentals, you can look past all of those things. So as an agency owner or business owner, you kind of have to engineer that and really think about what are all the levers available to me to make sure that every month either revenue is growing or there's this consistency in the makeup of my revenue that helps me grow into the future. And so that if an investor looks at this business, they're going to want to invest. And even if they don't want to invest, this is a business that I would like to keep running because I know every month it's spitting off like, 20, 30, 50% margins that I can just pay out as dividends to myself or my
Mhm.
other shareholders.
So let's unpack some of the narratives. So like I like the ownership accelerator I was telling you with that I was just on. So I got clients. One is in electrical contracting, one is in commercial cleaning, one is in one's steel fabrication, one is in retail, one's in e-commerce, one's in SaaS. So it's truly all over the board. And certain ones, like the e-commerce ones, my buddy, he's an he's an engineer with his funnel, right? Like, he like you got the data and all that stuff, but then you got other people where it's like, hey, these jobs are $2 million a pop, and it's a lot of like, so there's just this spectrum of the ability to get that visibility. So I believe that it's possible. And it's very difficult for me because I came from the copier sales world. So it was like 400 phone calls, 15 appointments, seven net news, five proposals, three closes, and like literally our entire 22 sales force. We could go to the bank with 33% of that close rate and for 20 years. And so like I had all that data and I like it was weird to me because that's the world I grew up in. And I realized how uncommon that is. But like, what do you do to someone that says like, well, my industry or my company is difficult? Like how like maybe this goes back to the diagnosing point or the starting point.
Yeah. I would say that the number of, so I meet hundreds, if not thousands, of companies a year. And the number of times I've heard my industry is different or my company is different, it's like probably 80% plus of the time. And the reason, and I'd say that I believe them and I understand why they think that, but the fundamentals of growth and revenue and sales and marketing are the same in every industry. And I like to talk about like it almost is like a pyramid of sophistication. It's one of our core frameworks. So you have layer one, which is like your foundational stuff. Layer two is like your actual programs that you run. Layer three is resourcing. And then finally, you get this outcome of revenue growth. And the layer one of foundational work, this is really understanding your ICP, sizing your market, knowing your TAM, knowing your segmentation, and knowing who you're going after and how many of them are out there. A lot of companies have not done this work. They don't truly understand who they're going after. And use myself as an example. I could say, like, our company is called How to SaaS, but we really work with private equity investors. I could easily say that we can serve any SaaS company, and it's true that we can. But by really focusing on private equity, we have a, a database of just the private equity firms segmented by type of private equity firm, type of investments they make, average check size, how much their fund is, et cetera, pretty much built out. And that's what we focus all of our sales and marketing activities on because we look at that as the core driver of our business. If I was just in the SaaS world, I would treat that very differently. Maybe I would go speak at a different conference. Maybe I'd invest in different ads. So that's the starting point. Number two is product marketing and really nailing down. Now that you know who you're going after, what is it that you want to say to them? What separates you? What are the differentiators? What are the solutions that you're bringing? What are the pain points that you're addressing? And I'd say in a lot of cases, people haven't translated that because there's still like a generalist offering. They will take any type of client. They won't say no to business, and this has costs downstream because at the front end it looks like you're closing more deals, but we all know this from an operations standpoint. If every engagement looks different, you can't optimize, and your margins shrink. So you want your margins to be as high as possible. A good services business should have gross margins of over 70%. To me, that is a healthy business. If you're like gross margins are 50% or lower, you don't have a good service business. You're kind of like a glorified freelancer at that point.
And I think it's really, just to comment, I think it's really interesting how, I mean, services-based companies have a harder time with that and picking their lane than like, I mean, my client who's a manufacturer is like, I have to buy a $1.5 million steel fabrication machine. Like we have to say yes or no. We can't customize everything. So like there's certain maturity parts of the manufacturing, but the services, like the discipline, it's almost like this leap of faith that like, if I do this, good things will happen. And it's scary for a lot of people. I've been through it myself.
You have to be comfortable saying no to revenue. And like, especially in the early days, it's hard because, if you quit a job or you have a family and you're just trying to, make ends meet, and you have a deal on the table that isn't an exact fit, you're like, should I say no to this? And I'd say there's nothing wrong with taking on work to keep the lights on while you're building your core business.
Be honest about it though.
Yeah.
Right?
At a certain point, you have to make that shift where you say, we do X, we don't do Y. And if you want Y, we can connect you with other people, or you need to go somewhere else, but that's not what we do. And the value of that is the better you get with the TAM and segmentation on the product and product marketing piece, and really knowing who you're after and what you offer them, is it affects pricing and it affects positioning. And the better you are at the one thing, the more you can charge for it. And you want to be able to charge as much as possible, because not only does it lead to margin expansion and better gross margins, but it positions you in the marketplace as the person. So I mentioned marketing due diligence earlier. There are a lot of agencies that could try to compete with us there, but they wouldn't be able to. It would take them years to build the PE relationships or to write the books or the social media work that we've done, et cetera. So they could try to enter the market and they may be able to price it as something, but they'd have to price it much cheaper than us. And we can charge way more. And that allows me to now downstream hire the right team, have better experts. And then it becomes like this.
It's a flywheel.
Yeah, it's a virtuous cycle, right? I can charge more, I have better margins, I can hire better team members, leads to better results, I can charge more, and just kind of keeps feeding itself. So I'd say that's the second thing.
And that was the layer 2?
Yeah, and no, well, that's still layer 1. And then
okay, got it. Yeah, okay.
And the third part of layer 1 is having the right strategy. Like, depending on who you're going after and what your deal sizes are, you have to really think about what is the right strategy to acquire that customer. So, for example, in my business, the private equity relationships matter. So sales is a very important tactic to build the relationships. And we initially used to do a lot of cold outbound to private equity firms, and that didn't work. Then through events, we met a bunch of private equity investors. Through referrals, I met a lot of private equity investors, but that wasn't scalable enough. So we kept hitting this wall of like, we're only meeting a handful of private equity investors a month, and we want to meet many more. And so last year, we figured it out. We started a podcast where we only interview private equity folks, and it's called the Private Equity Value Creation Podcast. And that allowed us to, like, we've met hundreds of PE folks since we launched that thing, right?
Good for you.
It's based
so
on
awesome.
Content-based networking play that this guy made, Poppy James Carberry. Anyways, the great book. But I'd say in any industry, it doesn't mean that every industry should start a podcast. But the point is that you got to figure out what is that avenue for you to reach your market in the best possible way so that they enter your funnel, and in the most cost-effective way so that your margins don't shrink. Again, I always bring it back to what's the point of running an agency, which is supposed to be a cash flow positive business, if you can't pay yourself enough dividends? It's not worth the headache. You may as well.
It's every business, man.
Yeah.
And it's so fascinating, Shiv, and I want to make sure we continue to layer 2 and 3, but to comment about this is like, it seems like it's obvious to me you're a first principle thinker. We're like, we have to go from the thing that we're trying to accomplish all the way down to the outcome. which is so fascinating because like as I've been doing this, man, for over 10 years, like it like infuriates me how many people are willing to take money from people and have zero skin in the game to like the Nassim Taleb, like, or care. Like it's like, okay, well, like because you naturally brought up strategic planning pretty much. It's like if you don't know who the hell you are as a company or where you're going, how are you going to put an ad in a podcast or go to a trade show or like give the salesperson the flyer? It's like you have to like pick who you are, where you are, and like to your all your criteria. So then you can put those like and it ties right into then your client acquisition costs onto your revenue GL goes like how much revenue are we going to get in each of these buckets? And then how much is it going to freaking cost to do that? And if we don't know what we're doing for the people that we're talking to, we don't know how much it's going to cost. And like, it's just
100%.
fascinating, isn't it?
I can't tell you how many companies, and I'm not talking about small companies, like we've audited public companies, $800 million companies, $500 million companies, and I can't tell you how many companies we've audited. It's north of 90%, where at least 30, if not 50% of their budget is going to waste. And I'm not just talking about it on ads. I'm talking about in terms of people, in terms of programs, in terms of the content that they're producing. It's just it feels productive because there's activity, but it's just completely there's no return
All
on
right.
that
So I'm
growth.
curious. And yeah, if what do you think about my thinking here? Because I've had 2,000 business owners come through my material where I teach about valuations and multiples. So you're talking about, I love how you read because I teach about weighted average cost of capital. Like we have to understand the build up methodology to say like, if we're, if we're trying to build value or place, do we keep our capital in our own company? Do we give it to someone else? If someone wants to plop their capital into here, like that's the name of the game. Like, and so what I have found is the wildest shit, Shiv, is that like 80+% of owner leaders or even like they have the wrong goal. So if like you have the wrong goal of revenue or net income, it has to be multiple growth with weighted average cost of capital and the sustainability of that normalized EBITDA and debt. And if those three KPIs are not our goals, it makes complete sense that 20 to 30% of people are just wasting their money on shit that doesn't matter.
Yeah, I'd say I completely agree. I phrase it as I would just add something to that to say that the metrics that really matter that I think people get wrong is having the wrong expectations for their business. And because we work with private equity backed companies, in their cases, they're doing a full 3-year annual and also an annual forecast. There's monthly projections, there's quarterly board meetings, and they're checking forecast versus actuals. And there's a ton of discipline in that. But even with the discipline, there's a gap in what a company might expect versus what's actually possible in that business. And I think like just like an individual, right? I think self-awareness is a very high value trait in an individual. I think for a company or a business, self-awareness is one of the highest value traits because you need to know what business you're in. You need to know what is a reasonable amount to expect out of that business given the market dynamics, given the customers that you're going after, given your offering, and then you need to make assumptions against that or make strategic plans against that. And where there's a mismatch often is if you expect, let's say you're running a $2 million agency and you're expecting it to double in the next year, odds are you're going to be wrong in this current market environment. But then if you start spending as if you're going to get to 2x your size by next year, very quickly you're going to see erosion of your margins. So really understanding the levers and then the data behind that. So a lever could be, excuse me, like let's say every time you go to a trade show or you speak at an event, you get a couple of clients. So you're like, I'm going to go to 10 more trade shows this year. And clearly, every time I go to trade show, I get one or two more clients. So obviously, I'll get two clients. So I'll get 20 more clients this year. And that's not true because there's a law of diminishing returns. It might be that your top three events contribute the bulk of your revenue from events, and then the rest are just hot garbage that you're just spewing money after, right? So having the right expectation for each of those areas, whether it's paid advertising, whether it's the content that you're producing, whether it's social media, whether it's events, whether if it's partners, and then having a realistic assumption about what what the revenue target should be, and then what cost base should be allocated to each area, and then what type of margins you're ultimately shooting towards. Like for our business, I have a few metrics that I think about. I think about gross margin. I want that to always be north of 70%. Two is effective hourly rate. Our target effective hourly rate is $1,000 an hour. We don't always hit it. We're sometimes way under, but that's our aspirational rate. And we do retrospectives after every engagement to figure out why we didn't hit that number. And then finally, I think about things like net margin and cost of acquisition and stuff like that. But the first two are really my governing principles, because if I overhire, my effective hourly rate is going to drop like crazy, right? And same thing with my gross margins. And so that helps me hire very smartly. And then finally, in terms of how I financially manage the business, I'm always thinking about cash flow. So I only hire people um, if I have at least 12 months of cash flow sitting in the bank. Until then, I won't hire another headcount. I don't want investors. I've wanted to build this business just by myself, bootstrapped, grown it slowly over the years. Now we're a multi seven figure business, but I never wanted outside investors because I wanted to do it on my own terms. And so I'll only hire someone once I have 12 months of cash flow. And between here and whenever that point is, we have to figure out how to optimize our operations. And so that's why we have our ops team, and we optimize everything that we were working on. And with that discipline, there are always trade-offs. Like if I need to, let's say, if I only have enough budget to hire one headcount, then does it go to client services or does it go to my go-to-market team? I'm always making that decision. And if client services needs it, then that's where it's going. And then we're going to just need to figure it out on the go-to-market side, which I think is a discipline that's missing inside a lot of, because cash flow is everything, right? It really changes how you can run your business.
Well, and it's your what I just heard is your ownership goals are driving the operational goals. Like 100%. Amen, brother. Like in so many times, I think what I have seen, and my father and I were just lived this Shiv 10 years ago, and I've had multiple other businesses trying to figure this out, but like it was like there with all of my clients, they started their business at, I mean, it's the E-Myth, man. Like, had the seizure, didn't want to work for the man or woman anymore, really good at your trade, knew there was a problem in the marketplace that they could do, good work for if they cared for their customers. Boom. Next thing you know, you got a $30 million business. And like you're learning EOS, you're learning all this stuff. And it's this revenue, net income, or revenue, margins, net income. And then there was like hopefully enough cash in the checking account. You know what I mean? And so like it's this understanding of how to tie the three statements together to get the visibility. It doesn't mean that like it all that provides is like what I heard out of what you just said that I thought was very worth noting is the trade-offs. It's the discipline of acknowledging there are trade-offs and there are constraints based on your goals of I want 12 months of cash flow. I'm not willing to do other things. So like we have limited resources given what we have right here. And then your decisions, I think, pop to there. And like that should then layer all the way into the marketing, right? I mean, like it's so fascinating to hear you say that.
Yeah, there's actually one of my other goals, you talk about ownership goals, is there's a certain percentage in dividends that I want to take out every year. And
Love it, dude. Love it.
that always guides how much costs I'm putting on the business. And I think people should think about that. There's a great book called Profit First.
Yeah, Mike's been on my podcast a couple times.
Yeah, great book worth reading as well. And just I think if you're making a ton of revenue but you're not removing some of that for yourself over time as a services business, it's a mistake, because you never know when the revenue could dry up, and you have to protect your personal side. The second thing I wanted to mention is there's a book that I talk about, or like an article that I talk about a lot. It's taught in the first year of business schools everywhere. It's called What is Strategy? And it's by Michael Porter. And it talks about this idea that strategy it's not about being better than your competitors. It's about being different than your competitors. And good strategy involves trade-offs. And a really good example that I use to explain this to people is like IKEA. If you were to go buy furniture at IKEA, everybody's gone through that maze in the showroom and then gone to the warehouse, picked up something, put it in your car. Like you don't really think about it. But can you imagine if IKEA entered into the market of bespoke furniture tomorrow? It would not make any sense to you. You got to wait 8 to 12 weeks for a couch from IKEA. You would never even dream of that, right? And on the flip side, there might be like places like Restoration Hardware where you would never expect them to behave like an IKEA because it's a mismatch for who that business is. And so if we think about IKEA, like what are their pillars or strategic pillars? It's self-assembly, self-transport, easy to use, easy to assemble, cheaper, affordable, right? Those five things determine everything IKEA does. And if you think about your business, you probably have 4 or 5 pillars that are core to what you do that help you make sound decisions. So even if something generates a return for what your position is in a marketplace, it likely doesn't make sense. And that becomes a way or a mechanism to say no. So I'm sure somewhere in a board meeting at IKEA, somebody said, hey, maybe we should sell bespoke furniture. And it's been an easy thing to shut down, right?
I heard this phrase, and then maybe it was in that article that you mentioned, but like a good strategy, the opposite should also be a good strategy.
Right.
And if
Totally.
it's not, and if the opposite is absurd, it's not even a strategy. Like our strategy is to have integrity. Well, the opposite is to have no integrity. That's not a strategy. So
Not a
like
strategy.
you just kind of keep zooming in until like the opposite actually is worthwhile. You just chose not to.
For sure. And the more specific you are, the better it is. So like I have this strategic map for our business, and for example, private equity is one of the pillars. Uh, Even though I can sell the founder, we have sold the founders, like, but founders is not a pillar because the business, the health of the business is contingent upon our private equity partnerships. So like there are things that I do, like we send very expensive gifts to our private, we've sent iPads, Apple Watches, like expensive bottles of wine and alcohol and stuff like that. Like we've done stuff like that to as every time a private equity partner gets promoted or they have a baby, like things like that. Like gifting is a big part of our business, um, and gifting as a demand generation strategy, I put that in air quotes, would not be considered in a lot of markets, but in our business gifting is such a huge lever. So but in another business it might not make sense at all.
Mm-hmm. So let's go. Maybe that ties into your layer 2 or 3, or like specifically on this predictable revenue is like, and maybe you're getting into this, like how someone can get through that false narrative of like, okay, it is possible to get that clarity.
Yeah, so it's actually touching on some of the stuff that I was saying is once you know kind of who you're going after, what the right strategy should be, then certain things start to make more sense than others. I have this matrix that says based on deal size, which channels are more effective. For example, if your average deal size is 100K plus, odds are SEO should not be one of the main things that you focus on, right? But a lot of people sell SEO services to companies successfully that are that big who may not find an end result from that activity, or even large companies will have an SEO person before they have some other areas. So really understanding which channels are more important than others, and then having a prioritized list. And one way to kind of think about a simplified way is like um, swim lanes of people that are ready to buy, or like let's say hot, warm, cold. So people that are completely ready to buy, you should focus on those folks first. And in your market, that might be different. It might be existing customers where you can cross sell and upsell. It might be partners. It might be people that are already in market. And what are the ways you can reach those folks before people that are not yet in market? And building a roadmap of activities to kind of execute against for your business.
So take your current funnel and say, okay, how do we pull them down further, but starting with the bottom of the funnel, then kind of working your way up, because like you don't need to be doing billboards right now if you got a pretty hot bottom of the funnel that people are really waiting to buy for you.
For sure. And I'd say some of this stuff is self-explanatory, but when you look at businesses, it's kind of shocking how people don't do the fundamental things that can really make an impact for their business. Like, how do we maximize the LTV of an existing customer? What can we cross sell and upsell to them? Are there other products or services that they need that we can support them with as an add on to our existing offering that is still core to our business? Like, those kinds of existential questions can create tremendous value for the organization without the added cost or customer acquisition cost.
Well, let's okay, I got some questions for you, man. Like on the so I love the client acquisition cost metric, the CAC, and then the long lifetime value of a customer. data point. How many people actually can generate that number? I mean, like, I think about how many people I've gone through, and it's like, if you just knew that, like, I mean, so like, do you think it's an issue of getting the data, getting the disciplines and the processes to get the data, or not knowing that it's necessary? Or like, where does this root problem come from?
Yeah, I'd say that that's one of the other missing components or areas that founders or operators don't focus on enough is really understanding their metrics at every stage. So if you think about it from lead to MQL to SQL to opportunity or close one or whatever, at every stage, what are your conversion rates? Some channels are more effective than others. Do you know which channels are more effective and why? How much more effective? What does it cost you to acquire a customer through events, let's say, versus paid media versus another channel? As you start to look at that at a very detailed level, this is when I said we find a ton of inefficiency inside companies. When we do this analysis, we will find 30 to 50% inefficiency. And I think if founders or whoever's listening just goes and does this work, they'll find so much value in their existing companies after this podcast. So I'd say just doing that step is understanding your data. And in a lot of cases, that either the data exists or there's some basic data ops work that needs to be done to extract the data, but nobody's actually taken the time to do that work to actually summarize it in a way that you would for a board meeting. Like if you have a board meeting, you have to, or if you want to sell your business, you have to explain go-to-market efficiency. You have to explain what's working. You have to explain ROI on certain campaigns. But do you have those meetings internally? Do you have like a regular feedback loop to improve on your spend? So I think just building that discipline inside of an organization, that in itself can change the roadmap, the programs you invest in, and what your focus areas are.
Well, and so like 100%, dude, love it. And I think what's fascinating is like, if I go back to why is it that most people don't have this? Because like if you don't have the data and you know why you need it, you're gonna build a project or a rock or some whatever around. Go get it. Put in the software. Change the people's behavior in the department, because like, but I think is part of the root problem is why the hell does this matter? And it's like, well, if you can't explain to yourself or to an investor or to the board that it takes me, $3,000 to acquire this customer and we keep them for 18 months and it's 10 grand in margin, we're willing to pay 30%
for sure
to acquire that. Like, well, duh, who wouldn't pay three grand to keep $10,000? But and then that all ties into then the normalized EBIT and the multiple. And like, I guess it's just so fascinating that people don't just like scour heaven or like, raise heaven and earth or whatever the phrase would be to go get that information.
There have been a lot of business books over the years written on topics like this, like management by objectives as a concept, or OKRs as a concept, like just general, like Jack Welch is the one that popularized a lot of this stuff. Like it's super simple. Even if you're running a company internal, forget if you're not going to sell it, just to be able to articulate how effective every department is and what are the KPIs and how do you measure performance and how do you improve upon that is super important. And we were talking about reasons why companies don't get acquired earlier. One of the reasons is that the data and all the data room for all the legal, financial, go-to-market, all is just not organized. And so
they can't trust trust the story of the future cash flow, right?
Exactly. And so it's whether like the being acquired is like a good frame of thinking, because it helps you understand what you actually need to have in place in order to increase your maturity anyways. And one of those things is really knowing and having full transparency and visibility into your entire business like an engine, so that you know where the dials are and what to increase or decrease over time.
So then when you go into and agreed, because like if someone wants to even keep their company, you even said it earlier, it's more fun to own, because if you're getting the dividends that you want through the distributions, you can log on to a monthly meeting and be like, what's my LTV? What's my CAC? What's my working capital? I mean, like, so that way it's just like a stock, just like all the other PE firms are doing that you've worked with. And then I think, going back to then, okay, so someone says, okay, like I now, it's the positioning and the target, the TAM, the market, all that kind of stuff going into this. And okay, now I've got, because I got my ownership distribution goals, I got my growth goals, I've got now $500,000 to spend, and like here are the levers. So like now you're starting to build those conversion rates. So then how, like you're just continuing to just unpack
And then you're just
each.
prioritizing and you're thinking the same thing in terms of headcount required to make those things a reality. Headcount and prioritization are so intertwined, right? Many times headcount leans towards one strategy when it's completely the wrong strategy, or the wrong. So you may have specializations in certain areas, but if you were to really audit your business, you actually don't need to do that, right? If events is a great example of it. Events takes human capital, and you might be going to 20 events a year. And if you really look at the data, and across the board, when we look at events data for companies, 80% of the value is created by 20% of the events. It is a hard and fast rule. But if you're staffed up so that you can go to all 20 events, well, likely, you're wasting 80% of that spend. And so that could be reallocated to things that are more profitable. And at the same time, there might be things that you need to do for your core business that you're currently not doing because your capital is currently deployed incorrectly, that you need to think about. Maybe you should be investing into a different channel that builds your thought leadership or presence in a marketplace. Maybe you should be building a better profile on LinkedIn as an expert in whatever it is that your service is offering is. All of these things take money, they take time, they take effort, they take content. And in order to do that, you gotta have the money to put behind it, right?
And position that arrow in the direction that you've already identified,
Exactly.
that you've helped us describe. Yeah.
Exactly.
How did this topic then tee you up into then the exit ready marketing? Like, so like how, like when you talk about the two big events that you were finding.
Yeah. For me, I've always just been passionate about founders and entrepreneurship. That's a big reason why I do what I do. And when I wrote the first book, it led to a lot of PE investors working with us. But then slowly we started working with more and more founders. And I realized, like, founders that are on the verge of exit just need to get certain things in order, and they can increase their likelihood of exit and increase likely the valuation that they exit for. And a lot of the principles are the same, but it's about educating them on that. There's just a gap. And so that's why I wrote this one, is just to help them figure. And there are other books that have talked about the concept of being acquired in general. Like you mentioned John Worrell earlier, he's written some stuff on this.
Do you know Ted he's the author of Branding for Buyout?
Yeah.
I gotta introduce you guys. Yeah.
Yeah. I don't know him,
but I think he's a way big up market is what I've been gathering from him.
Right. Yeah. So, those kinds of books exist, but nothing on just revenue predictability and some of the fundamental things that need to be put into place that could be a pretty meaningful event for founders. Because in general, founders have one of these events in their lifetime. To get it right, it can change your life. It can change your family's life. It can change your community's life. And so it's worth it to do some of this work, because you're going to end up doing it in one way or another. Either you're going to do it post-close, and then the investor is going to make you stick around for a little while with golden handcuffs and all of that, or you do it before close and you get a much higher valuation, and it's easier to part ways or move on to your next thing.
And I am a believer that if they do this now, it's really fun to collect the distributions while someone else is running your company. And then you're really just like, Shiv, I'm just completely convinced that people can become capital allocators if they want to, if they figure out their ownership goals and then back into, okay, X amount of money. And I really think that revenue predictability is like, if they can't log in to a monthly meeting to figure out what the cash flow forecast is going to be in the middle of next year, how can anybody?
100%.
And then like all that stomach ache that they're living with is the same freaking stomach ache that is going to ding their valuation on the multiple.
Yeah, you need to know that at all times. You need to live and breathe that. The finance and the ownership goals should really be the starting point, and then everything kind of cascades from there.
This has been a fun conversation, man. For the owner operators listening in, like, where do you get started? Like, what's like, if someone going, okay, I'm bought in, Ryan and Shiv, like, understood. How do you make this digestible? I've always struggled with that, because it's like, I do everything at once. And obviously you and I both know that it can't be done, but like, there are certain ways to make this accessible to people.
Yeah, I would just say, go get a copy of my new book, Exit Ready Marketing. It's in pretty much all bookstores, Amazon, Apple Books, etc. And then if you want to get in touch, you can find me on LinkedIn or just our website.
Is that the first book that people should pick up? Like, let's say they just swallowed the red pill and said, you know what? I just need to shift all of my priorities, get my right marketing priorities and sales priorities in line. Is that the first book that they should pick up, or the post acquisition?
That's what I would say. But
Okay.
I would actually recommend one other book, is the John Warlow one. It's called Built to Sell.
Okay.
I would say it's more of a
No,
conceptual.
I'm specifically talking about yours because I've had John on the podcast a couple of times and all that stuff. So I'm specifically thinking of like the people listening in onto this episode are still focused on the revenue predictability. So like, and I meant specifically about your two books. So is the
Between the two, yes, for sure. Exit Ready would be a better fit for this audience, for sure. Yes. But
awesome, man.
and yeah, I still do think the Built to Sell as a framework is a great book to read too. But this is like, what I've written is more specific in terms of how to make it happen for your business. So.
Well, and I think that's where that's the space I'm trying to fill, Shiv, is that like people are going, got it. You know what I mean? Like, but then there's like what I found is the challenge over the last decade is like there's too much of the I like more convincing of people what they already need, they already know. And like, and at the end of the day, it's pulling the threading the needle all the way from your concept to their goals of distributions and equity. And everything falls short. And that's what I'm trying to do with this podcast is finding people like you in the expertise and the domains to say, you understand how what you're doing impacts the entire life cycle of everything. And so anybody else that you know that is like, okay, whatever profession that they are in, honestly, Shiv, it's like, I just want people to understand the ownership game and not just be like, hey, things are just do it like this. And it's just a bunch of crap.
Totally agree. And yeah, if anybody wants to reach out beyond that, howtosas.com is the other way to find us.
You are amazing, man. I appreciate the time on it. And I thank you for coming on.
Thanks for having me, Ryan. Have a good one.
I hope you enjoyed that conversation. A lot to take away. I'd say here's my little 2 cents on marketing and how to tie marketing initiatives into the ownership goals. So many times I see people spend money or engage with marketing, strategic planning, or sales companies hoping they're going to grow. Usually they're hoping they're going to grow top line. And if you ask why 5 times, it ends up because people want more time, they want more cash flow, they want more equity, but they don't know how to tie their marketing initiatives and spend to growing equity and cash flow. So they just throw stuff against the wall, hoping it works. And what I like about what Shiv talks about is that he has to be responsible for the results working for private equity firms because they don't accept anything other than a return on investment. And that is exactly what you should be thinking when you're thinking about your marketing. You should be spending money that delivers that client, the client acquisition cost at a price that makes sense for your lifetime value of a customer, that profit and that cash flow that you're going to generate while working with that client, delivering your products or goods or services. So you absolutely can be thinking the same way, and you should be demanding the same thing for your marketing department because the data is there now. And one of the big hangups I see a lot of times is people don't have a formal strategic plan. They don't understand how they're going to fund the company or how much funding they have available in a specific year and the best ways to use that capital. So a lot of this is guessing, but what Shiv is talking about and why he ended up talking about strategic planning is because that needs to be done to make sure that you're going after the right customers at the right price, at the right offering. So that way you can then be as effective as possible and like a sniper to deliver those marketing strategies in a way that you know that you're going to get the return. So I know it's a lot easier said than done. However, I believe everything starts with a plan and understanding your ownership's goals, your valuation, how much you have to fund your company, and the knowledge and the clarity as an owner becomes so important, which is why I think private equity firms do such a good job at it. And you have the opportunity as an owner operator to do the same thing. And then you can actually tie that back into your goals of time, cash flow, and equity and independence. So thanks everybody for tuning in. I really hope you enjoyed this episode. If you liked it, share it with a friend. Please rate the podcast on the podcast player that you're listening to, or check it out on YouTube and subscribe there. Thanks everybody for tuning in, and I will see you next week.